What's up guys, it's Kevin with the Spark Investors. Welcome back to the channel. If you're new here, make sure to hit the subscription button and the notification bell to stay up to date with all our updates. And if you do like this video, make sure you guys hit the like button. So you requested that we take a look at Pacific Gas and Electric Company. They provide energy service for California. The company is trading at about $9.50. Pre-COVID, they were trading at about a little over 20 bucks. So they just finished a Chapter 11 bankruptcy. Their electrical grid caused massive wildfires in California, and they had to settle lawsuits for about $25.5 billion. Recent CEO stepped down. They plan to get a new one right now. They have a stand-in guy. It's William Smith. He was formerly of AT&T, and it is completely overhauled. Its board of directors, you got a lot of new people. The company has to make a lot of improvements and repairs to their equipment, especially their electrical grid, which again caused that wildfire and could potentially cause a fire again if they don't get it repaired and updated. To get everything updated, it looks like it'll take roughly $40 billion. And this isn't the first time this company has performed Chapter 11 bankruptcy. It also did so in 2004, continued to push for profits and didn't update its equipment, and it inevitably made them go bankrupt. Have been prohibited from raising any rates and must give customers an affordable option. So right now, California is currently having a lot of blackouts due to increased demand from the heat wave. So a lot of people running air conditioners and things like that, and their equipment just can't handle it. So what they're doing is they're giving some people service for a little bit, and then they're going to the next people and giving them service. That way they can kind of just share the power with everybody. The state has also went heavily into solar panels and other renewable energy solutions, and this can't keep up with the demand during these times where they have these heat waves. It just can't keep up. Like Pacific Gas and Electric, it needs to be there to be able to kick in and pick up the gap. You got to think a lot of people are staying at home right now, a lot more than usual, so the demand is just dramatically increased from normal levels. It's also a little bit older, and it typically starts to fail when it gets a little overheated, so that's also bad. So when people are using it more, their equipment starts to fail. So that's something that they got to get fixed. At the end of July, they announced an earnings per share of $1.03. This beat expectations. Don't expect any kind of dividend from this company for a long time. They have been losing money and will probably continue to lose money for a while. They haven't had positive net income since 2017. The company does look like it has decent plans in place to get back on track, which is outlined in their plan for reorganization commitments. They do have a lot of work to get back on track. However, with the low price that it's at right now, I'm gonna go ahead and give this a 5 Spark rating. And this is kind of contingent on if they can do the right thing and give customers quality service and do the ethical thing, fix all of their stuff. If they don't do that, you might still steer clear of it, but if they do, this company could probably eventually become profitable. But they're gonna have to fix that equipment, because in the long term, if they don't have good equipment, they're not gonna give good service, and they'll probably cause another wildfire and go bankrupt again. They are the largest provider in California, so that gives them the opportunity to really make a lot of money as long as they give the service that the state needs. They're gonna have to continue to pay off debt and make improvements to the equipment to continue to keep customers safe. They will need to lower their payout ratio when they do start paying out dividends in order to keep cash on hand to do repairs and upkeep. They were doing about a 70% payout ratio before they cut their dividend, and they're gonna have to dramatically decrease that because it costs a lot of money to keep that equipment up to date, and it's obviously been shown that it can become very dangerous when neglected. This will be a riskier investment. Like I said earlier, it's probably trading close to the bottom. It may go a little bit lower, but it's probably gonna go up in price. So it's not probably a stock that you can just buy and just hold. You're probably gonna have to keep an eye on it and make sure that they're not doing some sketchy stuff or anything like that. They've pretty much revamped their team, so hopefully that's not gonna be the case. Hopefully they're gonna have some good people in place, and then they'll go on track to start making the right decisions and give the good service that customers need. This is going to be a pretty long hold because they do have those lawsuits and things like that they got to pay off, and the amount of money that it's going to cost to update this equipment. Thanks for watching, guys. We super appreciate it. If you liked it, make sure to hit the like button. If you want to see more content like this, make sure to subscribe, hit the notification bell. Let us know down in the comments any companies that you want us to check out or any other things that you want us to talk about here on the channel. If you want to get started trading, you can get 3 free stocks, one for signing up for Webull, another one you make a $100 deposit, and then a third one for signing up for Robinhood. I'll see you next time.